the ultimate guide to retirement plans with a goal to show you the largest tax deductions available in qualified plans. Now, there's many types of retirement plans. Most people don't know that there's actually 6 of them. But we're going to show you how to maximize contributions and financial benefits for the business owner and physicians of high-income business owners. There are 4 core plans. You have on the left side all the qualified plans, which first one's a profit-sharing 401k type plan. And then the second tier, generally used by most financial planners, is cash balance plans. But they don't generally know that there's both standard plans and enhanced plans. And then for those business owners and successful professionals that need a large deduction, we use the defined benefit plan called lump sum and benefit focused. On the right side is some specialized plans that are non-qualified that we will not be discussing in this meeting. And so when you run into very successful business owners and professionals that need a large tax deduction, where do financial advisors generally turn? Well, the most recommended plan is the standard cash balance plan. That's what they think is the best plan, not knowing that there's another tier of retirement plans called the benefit focused defined benefit plan. In addition to that, many advisors are not aware of how to turn all that money, pre-tax money, into tax-free money. And that's where the STAR strategy comes on that we snap on to the end of the development of these plans when they're fully funded. That will convert all the money we've created in these tax deferred retirement plans into tax-free. Now here's looking at a 52-year-old and the relationship and the maximum deductions you can have between all these retirement plans. And most people do not realize how large a deduction you can get. So if we look at the plan number 1, the 401k profit sharing plan, the most you can get into that plan is $76,500 in 2024. And the cash balance plan is nice, between $315,000 and $345,000. But the big dog, though, for those individuals who can afford and need a large tax deduction, the benefit focus plan can take them all the way up to $895,000 in deductions. Now, I've focused here on the word plan stacking because in many cases we use 2 retirement plans. And in very rare cases, but we also use 3 retirement plans. For example, we did a large medical practice in California where we put in the 401k profit sharing plan for employees. And then for the second tier of physicians that couldn't afford to save large amounts of money, we put in a cash balance plan where they could put $100,000 to $200,000 aside each year. And then for the older, more mature professionals, we set up a benefit focus plan where they could deduct up to $900,000 a year. Now, what creates this larger deduction for the benefit focus plan? We get higher deductions with greater tax deferral, lifetime income for the participant and their spouse, and the assets can potentially fund the next generation of retirement plans for employees who are family members who will inherit the business. Plus, there's an insured death benefit that if they should die early, the retirement plan is completely funded that way. So the focus is, rather than lump sum, we want a benefit focus where we're focusing on lifetime income. In addition, when we develop the benefit focus plan, rather than looking at income over a single life, we're developing income over 2 lives, husband and wife. And that increases the benefits and the deductions that you have to have. And then finally, there's a pre-retirement death benefit that's mandatory. And we use a life insurance policy to fund that, which also contributes to creating significant tax deductions. Who are our best candidates? Well, there's 3 types. Pass-through entities of business owners, high-income earners, and wealth transfer strategies. Business owners, doctors, athletes, you can read through that list. High-income earners are generally contributing ranges up to $150,000 to $1 million, depending on age and plan. Larger contribution for pre-tax dollars is greater deferrals. And these assets are protected from creditors, and they can potentially fund the retirement benefits for remaining employees, which can generally be the family members. Here's an example of a 52-year-old. You can see on the left and the center there what most advisors recommend is the cash balance plan, where you get a deduction of $315,000 in the first year, $240,000, $345,000, and by the fourth year, $365,000. So over that time period, they've deducted and saved taxes on $1,265,000. However, had they had the knowledge to present a large deduction defined benefit plan, a benefit focused plan, we could give them a much greater contribution of $595,000 the first year, $505,000, $640,000, and then $495,000, for a total of $2.2 million of tax deductions, which is giving them almost $1 million more in tax deductions, or a tax savings of, in a 35% tax bracket, of almost $339,000. Now, let me give you an example. Here's a physician that I was working with. And his wife ran the office, and she ran it like a drill instructor. And the physician's salary was $366,000, and the wife was paid $20,000, which she deferred into the 401k. However, the physician's K1 for that year was going to be another $700,000, and the doctor wanted large tax deduction, but he was only currently getting $52,000 going into the 401k plan. There was also 3 non-owner physicians earning between $160,000 and $220,000, which makes them highly compensated employees because they met that definition of what's a highly compensated employee. He also had 14 other employees, of which 9 were eligible for the plan. And the physician was tired of writing big tax checks, and he wanted to retire in no more than 7 years, so he had a real need to save money for retirement. The CPA for the client said he should not do a defined benefit plan because he'd have to give too much to employees and more than he'd pay in taxes. I didn't believe that was true, and I said, Paul, please give me all your information. When I came back to him, I said, Paul, you can look at what most advisors will tell you is the lump sum focus plan, where you and your wife would get, almost $315,000. Your employees only had to get $15,000, so your total tax deduction was $331,000. But you and your wife are getting 95% of that, which is pretty good, right? He said, yeah, that's very good, but my problem is $700,000. What am I going to have to pay taxes on? I said, well, would you be happy if we showed you the benefit focus plan where we're focusing on benefits for you and your wife, and now we take the deduction up to $703,000, and you and your wife are getting 96% of that. And that's exactly what he did. And the doctor installed the benefit focused defined benefit plan and paid no taxes on his company profits. And the doctor fired the CPA because of the advice he got from the CPA. Now here's another case, an attorney up in New York. He had a $3 million profit on his practice. And from his advisors, they said there's nearly nothing you can do. You just got to pay taxes. So between the feds and the state of New York, he paid about $1.6 million in taxes. And so when we were introduced to him, we said, okay, let's introduce you to the benefit-focused retirement plan. And you can see here under the maximum contribution column here that we gave him $2.7 million tax deduction, and he got a refund of almost the entirety of the taxes he paid for 2023. In addition to that, all the money he had to put into employees as they began to retire and leave, he would recapture all that money he put in for employees. But also notice that this type of plan, we give minimum deductions, so the following year, if he didn't have a good year, he could go down to $280,000. But if he had another great year, $3 million of profit, he could go up another $2.7 million. And he elected to point to $2.7 million. So that's how large a deduction we can create in these retirement plans. And our firm is a fiduciary-related firm for 338 and 321 fiduciaries, and we have audited by the AICPA organization as to our standards. And here's our contact information in Columbia, Maryland, that you can contact any of us at info at Columbia Benefits or any one of us individually. So thank you for your time, and we'll look forward to working with you and the possibility of working with you.